Wow, cool. Thank you so much, Es, for that. I think we'll quickly just move over to Tom from Frank. And, I think it would be interesting for you to provide this perspective from a platform sense, but also just share a little bit about your journey, what inspired you, obviously, to launch a platform like Frank, and what are some of the insights that you have to share on how people can think about crafting their own investment strategy.
Sure, thanks, Hope, and really good to be involved. So a little bit of background on myself. Had a similar sort of journey to what Es described. Both my parents were teachers, made terrible decisions when it came to money. And then my personal journey was actually going down quite a deep technical route. So I did an engineering degree and ended up doing my doctorate in engineering in machine learning, but never really was exposed to finance. And it was only when I finished, kind of after my PhD and working as a postdoc at MIT that I started getting a proper job. I worked for Discovery when I came back to South Africa, and I couldn't understand why investing was so complicated, why it was presented as being so complicated. So I suppose my process in investing was very much sort of looking at it from a first principles perspective, which is my kind of mindset and my framework. And on the basis of that, I built Frank, the platform to help people invest. And what I saw fundamentally was just an complexity which was unnecessary. So, what we offer in Frank, and it already has been touched on by Es in some ways, first and foremost, we help people make a good financial decision. So we are a licensed sort of advisor, and we provide that sort of advice through our mobile app around what they want to achieve. So it is sort of a goal-based, and I think it's important to realize that, your financial goals, whether it's, retiring early, as you say, that sort of FIRE goal, or, buying a house, or, putting your kids through university, whatever the case may be, each of those goals have a very specific time horizon, and as a result, there is associated sort of thought that should go into in terms of how much investment risk you should take on board. So our philosophy is really combining investments in the money market fund, so sort of an emergency fund goal, and once you've sort of set up that goal, really letting yourself to think more broadly about sort of investing in equity. And I want to just pause for a moment, just something that it's important that people sort of just separate these things out in their head. For me, I came to realize that actually saving was the process of not spending and putting money aside. But investing is really a very different kettle of fish, because obviously if you put your money with a bank, by and large, you're actually not getting an interest rate which is beating inflation. So in actual fact, your money is losing value over time. So to really internalize that, I think, is really important. So saving is the act of not spending on a monthly basis, but investing is really actually putting that money now to work. And I think, there's a horrendous statistic in South Africa, actually across sub-Saharan Africa, over 50% of people save, but less than 5% invest. And that for me is a tragedy, because obviously the vast majority of people are actually not generating any sort of real return on their money. So when it comes to investing, our philosophy was to help people invest regardless of how much money they have. So there's no investment minimum. A lot of the sort of traditional platforms put high minimums in place. 500 Rand, or if you want to open sort of an Allan Gray money market fund, for example, you need to have a 20,000 Rand opening account balance. And we believe that a lot of people just couldn't afford that. So we took away those minimums. So anybody can invest as much as they want when they want. But I fully agree with Es's comment there about sort of paying yourself first. So we definitely do advise to, once you've set a goal and we help you determine how much you should put away in order to achieve that goal, that you keep and you stick to those sort of monthly contributions. The other fund that we offer is the Satrix 40. So I think what's important here, and maybe I diverge a little bit, Es, from the sort of advice you've given thus far, to some degree. It's important that people understand this concept of diversification. some people, you may have heard of that comment, the only free lunch on Wall Street is diversification. And what that means is fundamentally that you're spreading your investment risk across many different, not only asset classes, but also across many companies. So, the old saying, don't put all your eggs in one basket. The equivalent in investing in equity would be putting all of your money with one company. If you put all that money with Tesla, sure, you may have done well over the past 5 years, but if you put all your money with Hertz, the car rental company, you would have lost all of your money. So, good ETFs inherently have that diversification. So Satrix 40, for example, is the top 40 companies on the Johannesburg Stock Exchange. The S&P 500 is the top 500 largest companies in the US, broadly speaking. So you're diversified across, in South Africa, at least those 40 companies, and obviously on the S&P 500 across 500 companies. So we believe that actually, and what that means fundamentally is that you're actually getting the best the market has to offer. Obviously, you can hope that you can try perform better. So what a lot of people do, and I think once you've built up confidence, then you can and should do this, is maybe for like 20 to 30% of your portfolio, look to stock pick. So you're trying to bet on a company that you think is going to do really, really well. And I agree with S's comments in that regard. However, the only thing I would say is that, at least my personal take or my personal behavior is going after companies that I know. So they in an industry that I know. Obviously, my background is in technology, so I know what's happening in the market. For me to go and invest in a hotel company, I don't have the time or the inclination or the depth of knowledge. I don't read annual reports. I don't read, all of those, the cash reports, because my background is in finance and I don't really enjoy those activities. But I do know what's happening in technology, for example. So I bought Tesla 10 years ago, which has worked out fantastically well, just as an example. So yeah, to summarize what Frank is, we're a platform, we're a mobile app. We want to help people invest who are new to investing. We give advice so we can help you understand how much risk is right for you, how much investment risk is right for what you want to achieve, and obviously help you figure out how much you should be putting away in order to achieve that goal. And then through the app, you can obviously manage your investments, contribute to investments, top up, etc. And yeah, I'll stop there.
Thank you so much, Tom. I think that is super insightful, just getting your perspective, obviously from a platform side, but also just some of your personal insights in terms of how you've crafted your own investment strategy. And I think just from you and S, the key things, just for those who have missed it, it's definitely have a goal, invest in what you understand in. And obviously there's different sort of asset classes. So it's just about doing that research to understand, which ones are the best ones for you against the risk appetite that you have. And then also just to recap, there are 2 links. So obviously if you're watching from this current link, then you are okay. But if you're struggling to hear the sound, there's also a link being streamed currently on YouTube. So please just look at our Twitter handles to kind of see how you navigate that, so that we don't want you to miss out. And then also this is currently being recorded. So if you do manage to not catch everything that has been discussed from the session, the Frank group will be dropping the recording, so then you'll be able to still capture some of the insights. We're going to move on to Fred, but I see he's dropped off for a moment, so maybe we can just address some of the questions. And I think Tom and Ez, whoever feels most comfortable to kind of address these questions, please do. Oh, I see he's come back. So Fred, okay, can you hear us?
Hi everyone, yeah, can you hear me?
Okay, cool. Fred, over to you. Same question, and obviously we'd like to hear about your personal journey and some of the lessons and insights along the way.
Cool. Sorry, could you just maybe repeat the question? I don't want the actual first question that you're asking.
Okay, so the question is just to learn about your journey, how you started investing, and what are some of the lessons and insights that you've uncovered along your investment journey of, I think, 4 years, as we've mentioned.
Great. Firstly, I want to say thank you to Hope. Thank you to all the speakers for having me. I think this is a really important chat to have. So, yeah, my name is Fred, and greetings to all the listeners. I have been trading and investing in the stock market for the last 4 years. My journey started off in, I would say, around June 2017. I was still at varsity at the time, and basically what had happened was when I was studying at varsity, I had a sponsor who had paid all my tuition and accommodation. So everything was covered. However, I applied for a scholarship in 2016, which I got in 2017. And this scholarship came with a monthly allowance of around 7,000 Rand. Now, at the time, to me, this was a lot of money. Still a student, I had no expenses because all my food was covered, accommodation, tuition. So, and this scholarship came along at a time where it was covered for entire of my degree. I was doing an economics honors degree, which took 4 years. So in 2017, I had 3 years left, right? And basically, for the duration of that 3 years, I managed to save about 80 of that total funds which I received. And I started getting into trading around about early 2017 as well. And that is where I found out about investing. I then went to look for a mentor, which I found online. His name is Gerald Peters. I speak really, really high of him, but he mentored me for about a year or two. That's where I really got into equities. That's when I started learning about how to buy shares in companies. And this was all still in my varsity. I was completing my second year, going into my third year. Fast forward to today, I managed to, from the starting capital which I had, I was quite fortunate to start with that starting capital. I managed to grow my portfolio by 50%. At the time, that starting capital which I received from my scholarship, I was quite disciplined enough to save that. The reason why as well was due to the fact that when I was at varsity, I was that type to always look for ways to make money. So I was working at a part-time job. I was also doing photography. I invested into a camera and started making money through photography at my time at varsity. So I had a bit of pocket money which I was making on my own. So a lot of the money which I received from my allowance, I genuinely did not need. And when I found Gerald Peters and I started paying for his mentoring sessions, he was with me for about a year or two. He really guided me because I was completely lost. I started off with trading and lost a lot of money at the start for the first 6 months. And as I was going through with him, he then introduced me to investing in the stock market. Um, so yeah, that's really, really where I started. And ever since, I've just been fascinated about investing, companies looking at technical analysis, looking at fundamental analysis. This is something that I enjoy doing. And that is really, really how I came about. If I have to explain to everyone my why was really the reason why I got into investing was when I've with my mentor Joe Peters, as he was explaining to me the fact that how you could ultimately at sometimes make your money work for you, like S was saying and Frank referred to. So this concept was really it intrigued me. And another reason was also due to the fact that I come from a really disadvantaged background. I'm an immigrant from Rwanda, moved to South Africa 18 years ago, and for the majority of the time, my mom lived in poverty. I used to live in a children's home. After the children's home, I went to varsity, and that's where this whole journey started. So when Gerald Peters started taking me through this process, and every week I would sit with him and we learn how to trade. We also talk about investing. I was quite intrigued, and I was like, "Whoa,
Oh no, I think we lost Fred there for a second, so we'll just see if he comes back in the next couple of seconds. And if not, I think we'll address some of the questions that have come in because I think there's quite a huge backlog. So I think let's do that in the meantime while we wait for Fred to come back in. So the earliest one that I can see is from Spicy Charlotte, who asks, how do your investments cover your expenses? Do you withdraw from your portfolio? I think this would be more directed to you, given just some of the insights that you shared in your talk.
So currently, I'm not withdrawing funds because I'm in the building phase. I'm literally in the accumulation phase where I'm growing my money to reach to the point, the amount I told you about, which is my monthly expenses times 300. That's my target. So right now, until that target is met, I'm sort of reinvesting my dividends and carrying on investing. And hopefully when I reach my target, then I can start withdrawing some of that. But for now, I reinvest everything. I don't withdraw. Until I reach my target, then I'll be able to start drawing on some of that income.
Yes, could I just add a quick comment here?
Yes, go ahead.
So on the dividends, I think a good rule of thumb is to know that with most ETFs, and the top two in mind, obviously Satrix 40 and S&P 500, on average, we're looking at about 2% per year of your investments are paid out in dividends. So, if you were to think of that sort of 300 factor, another way to think about it is, at the moment, what are your current expenses? And in order for you to cover that, times your monthly expenses times 12, and that needs to be 2% of your portfolio. So that gives you a sort of a target for you to be able to reach in order for your current monthly expenses to be met by dividends. What's important to know with dividends also is that they only typically pay out every quarter. So you get sort of it's not that you get a sort of a monthly income so much as a sort of a quarterly income, and you need to make sure that obviously that income covers your expenses as you roll throughout the year. But I think if you can use that simple formula as a way of determining, how large should your portfolio be invested in, S&P 500 or Satrix 40, for example, then how much money you're going to receive on an annual basis from dividends. It's important to note, though, currently in South Africa, dividends are taxed at, I believe it's 20%. I could be wrong, but you'd obviously have to take that into account when you do that sort of simple calculation for yourself.
Cool. Thank you so much for that, Tom. Fred, sorry,
Hi.
over
Sorry,
to you again.
apologies.
I think you got cut out for a bit.
Yeah, I think I'm just going to try and summarize just my story when I started. But basically, my starting capital I received from varsity, my scholarship allowance. The total in the 3 years is what I used to start off my investing journey. Yeah, so ever since that, I completed my economics honors degree in 2019. I then went into corporate in a sales position for about a year during 2020. Up until this year, Feb. So with regards to investing, I'm more of a long-term investor. I only buy shares my goal is to hold for at least till about 2030. Now I hold a portfolio with about 12 individual stocks, and I have 3 ETFs. I consider myself more of an aggressive investor. So I tend to hold the majority of my portfolio is weighted to I would say high risk stocks, if you can put it like that. And over the last, I would say, year, what I've experienced is that because last year when the when the global markets crashed, that was my first ever major crash that I've experienced. What that really taught me was to place a lot of emphasis on asset allocation, if I can refer to it as that. And what that basically means, to those who don't know, is being able to diversify your funds, and not only in your investment portfolio, but in funds such as your emergency fund. Maybe you could have a savings fund where you're saving for something for your business or for something that you might need. And the reason for that, I had a lot of family members who and friends who at the time just had a minor emergency fund, not a lot, but they had a lot of their money placed in the markets, in their portfolios. And when this crash happened, a few of them lost their jobs during COVID, and that what really caused them to actually sell their holdings at a loss. So I'm a big believer that once you get into investing, once you familiar with what a stock is, once you have an idea of when to possibly buy, you've got an understanding of a bit of technical analysis, you're not just buying. Or you could, if you are a long-term investor, decide you're going to take the dollar cost averaging method, what a lot of people refer to, or the rand cost averaging. I'm not sure if that is the actual term. You could decide that strategy. I think from my experience, really, one is to come up with a strategy that suits their needs and their financial situation, right? Every single one of us have a different level of income, right? We don't all earn the same money. So that's really important to note when it comes to investing, particularly when you're getting started. So for someone who has 100,000 Rand, for example, when they have a 10% return, it's different to someone.
Okay, no, I think we lost Fred again. So while we wait for him, as we did earlier, we'll just address some questions, very rapid fire. I think there's a question again from Spicy Shalate who asked, the amount that you want to save, or I guess in this case to invest, would you divide it by your gross or your net salary? So Tom, you guys can give your perspectives on this.
Sure. My my view here is, obviously the more the better. So if you looked at your gross salary, you'd obviously be, if you took 15% of your gross salary, that's going to be a larger amount than your net salary, which is obviously after expenses. And I think the only thing, just to, it's a small minor comment, but it definitely was my own personal experience. And I don't know if you had a similar experience, but once I saw the money I was putting away and the money I was investing working by itself, I wanted to invest more because I started to see how this capital could actually generate its own engine. So I would encourage people, as when they start, is really, as much as you can afford, even if it means shaving off, a few luxuries on a monthly basis, because I promise you, once you see that capital kind of generating its own momentum and growing, you will want to invest more. I guarantee it.
So if I can also weigh in on that question, I agree with what Thomas said. For me, the focus is not so much on your net salary, but on your expenses. So that income that you're able to draw is essentially to pay for your expenses. Your investment income that you want to be drawing over a few years is based on your expenses. So the focus should not be on gross or net salary, but on your expenses per month. And the higher your expenses are, the larger the amount you need. Hence, the calculation focuses around the expenses more than the income. So it has to do more with your expenses than the income or net salary that you get. And like Thomas said, the more you can put away, the better, and the earlier, because what are the factors that affect compounding? It's the amount and time. The earlier you start, the better. Because at least you have time on your side, and your investment amount can compound over time, and the amount that you're starting off with. So for me, I try to get, as I started off, it was a little amount, but the more I realized and the more value I saw in what I was doing, the more I was happy to increase that amount. And I've been able to increase that amount by just reducing some of the major expenses that we have as a family. And those major expenses for us have been a house, a car, medical expenses, and for us to really look at those expenses and say, how can we reduce as our income has grown? The last 2 years, we know the salaries have really been capped, but over the years, to say as our salary increases, we're still going to keep our expenses the same. We're still going to stay in the same house so that we don't increase our biggest expenses, and rather keep our expenses low so that we can invest more.
Yeah. Thank you so much for that, Es and Tom. I think that's quite powerful in terms of making sure that the focus is on expense management, and then, investing as much as possible from an income perspective, because I think people tend to focus on the income. So I think that's a very powerful point. Then there's a question from Efrates. When I buy a stock, it goes down. When I sell it, it goes up. How do I avoid this? Isn't this what we'd all wish wouldn't happen? So I don't know if Fred, if you're able to kind of address this. I know your internet might seem to drop on and off. So I don't know if you can address this, or Es and Tom, please feel free to go ahead.
I'll try. Yeah, I'll give it a go. So with regards to the actual markets, I think one fundamental thing everyone needs to understand is that we have no control of what the market does, right? So you could place a position now. Once you've bought those shares, you have no control, you have no idea where it goes. What I would recommend to a lot of people is to, if they're really, really concerned with regards to once they buy and it goes the opposite direction at which they thought, they should invest some time into learning and understanding the technical analysis side to stocks, to shares, right? Because what I've noticed in my past 4 years is the more I've learned and understood how to analyze a share price of a company, that has given me the chance to buy them at a low cost. So I don't think, to answer your question, Mr. Ted, I don't think you can actually avoid that. It's just the nature of the stock market. It's a really, really volatile market to be in. So, however, I do think you can avoid the time at which you, for example, if you buy and it goes down, I do think you can avoid the time at which you stay in a negative, for example, by learning and understanding how technical analysis works. Yeah, that's just really what I wanted to add.
Could I maybe just add another comment to that? So
please go
ahead. There are a couple of key things here. Obviously, as Fred mentioned, the stock market is a very volatile space, and the word volatile just means that it fluctuates. It can go up and it can go down, and as Fred mentioned, that is totally outside of your control. I think the also important thing is that it's actually very, very, very difficult to predict. I didn't mention earlier, but I spent some time working for a hedge fund in London doing what they call quantitative analysis. So that's building algorithms to try and trade in an automatic manner. And you had some of the smartest people still struggling to do this effectively. So my personal view is that instead of trying to time the market, and a lot of people, when they look backwards, they say, oh, if I just bought at that low point and sold at that high point, I would have been a millionaire. But the problem is actually, retrospectively, it's very easy to identify those points in time. But to know when that happens going forward is actually extraordinarily difficult. So the best thing to do is over the long term, the stock market has shown consistent long-term results. So the S&P 500, if you look at it over a 10-year time frame, including sort of, or 20-year time frame, taking into account the 2008 financial crash, it still grew on an annualized basis of 15%. So what that means is that if you had just kept up with your regular investments, and that also gives you the benefits Fred mentioned earlier of what they call cost averaging. So that means you take, as the price goes up and down, you effectively take the average of all of those fluctuations into the average price of your portfolio, which fundamentally determines your investment performance. So if you buy in every single month, you're putting in the same amount of money and almost not worrying about those sort of small micro fluctuations, over the long run, you should generally see, steady growth. So, my little kind of slight rule of thumb is if you're going to invest in the stock market, it would almost be like just investing and not looking at it. Because the moment you look at it, we're all human. We all hate to see any loss. And typically that results in an irrational decision, which is to sell at the wrong time. And what that means then is you realize your losses. If you don't sell, you're sure the value of your portfolio is down, but it can then turn around and then start going up again. But the moment you sell at that low point, you've kind of banked your loss. You've kind of basically given money away, and that's possibly the worst thing you could do.
Can I just add?
Thank you so much for that, Tom. Sorry, could we, because I think there's just a couple of questions coming in, Fred. So if you don't mind, if I could just keep, I guess, merging some of the questions coming from the YouTube chat as well. But I think just to emphasize what Fred and Tom was saying, there's a comment from Rakil just says, I just keep buying whether the prices go up and down, and they plan to do this for at least 10 years. And I think this emphasizes Tom's point around, don't sell when things go low, because then you basically won't be able to realize the gains from that stock potentially going up again. And then I think there's a number of questions around sort of, are there any educational courses or materials that people can engage with to kind of learn more? And this also just speaks to being able to conduct the technical analysis that Fred was talking about. So Fred, maybe you can speak to that in terms of what platforms you engage in to learn more, and then Tom also in terms of how the Frank app manages the educational process.
So yeah, with regards to resources, now on the internet itself, there's a lot of, obviously when you go on YouTube, there's a lot of resources one can find, right? But it does become very confusing for the average person who has no clue about investing. They're just starting off. For them to go and search on YouTube and then search, for example, investing strategies, and then see a bunch of options there and not know where to start can become very overwhelming and difficult, if I could put it in that manner. So for me, what I suggested is, I'm just going to speak from my experience. So when I started off in 2017, I started with trading, then I got into investing. What I noticed was when I started in the beginning, when I lost money, was even though I had the resources, which was the internet, the YouTube, I watched multiple videos on how to learn, how to learn to invest, how to trade, and I still continued making the same mistakes, right? So what, in my experience, helped me was when I got someone, one person, Gerald Peters, to name him, as a mentor, who then mentored me and said, listen, Fred, follow this strategy, go and research A, B, C, D. And for about a year, I literally just followed the method, right? Now, he had experience in this. He had been doing this for over 20 years. So for me, from that experience, what I can really suggest to people is try and find someone, or if you're going and looking on the internet, on YouTube, try and find one YouTube channel where you're like, okay, you've been following this person for a really long time and you like what the content they're putting out, and you're seeing that the strategies they're using is working for you, and then just follow that person. Do not switch from one person to another, because what they tend to do is everyone has a different way of interpreting the stock market, right? Everyone has different strategies they use. Everyone analyzes their fundamental analysis differently. So that is really, really one tip I think has worked for me, is find someone, or whether you go and hire a mentor in person or online, and then just stick with that person, because it's really going to cut a lot of your failures off. It's going to prevent you from making a lot of mistakes. You are still going to make mistakes in the beginning, but you won't make as much, because you'll be learning just from one person, one strategy, one way of doing things, as opposed to multiple things. So yeah, I don't know if that really answers it, but that's just my take on it.
Okay. No, thank you so much. Tom, go ahead.
Yeah, so So obviously that's part of the reason why we started Frank, and choosing the name Frank was really to try and be straightforward and, simple language and help people understand. My impression has been for a long period of time, there's been information asymmetry. People who have knowledge, they're sort of only willing to share it for a fee quite often. And I do believe that sort of access to financial knowledge is almost a human right. I feel that anything else is actually, just a travesty, really. So, on Frank, we soon to be launching our academy, which we're really excited about, which will have kind of a structured courseware taking you through sort of, basic principles, money management, investing basics, and moving on to more complicated and sophisticated things, including technical analysis. But in terms of the resources and also the process, I would, fully encourage people to, even when you're learning to swim, you don't necessarily jump in the deep end. So I would suggest, start in the shallow end, which is sort of get an emergency fund up and running, invest in an index, which you're getting kind of the market, and view that investment as a long-term investment, so at least 5 to 10 years, and putting money in regularly. And then as you become more comfortable and start seeing some of the dynamics, then by all means, there's so many resources you can and different strategies you can employ. But, my personal view is really any strategy that you do adopt for kind of stock picking or, making your trades, you should really only be doing that with sort of, 20, 30%. That would be my sort of, my safe area, because there's a possibility that the strategy that you choose is wrong, or it's not a good one. And you don't want to be risking a good chunk of your capital on some of those strategies. So I would encourage people to start at the shallow end, set up an emergency fund, invest in an index. Satrix 40 is a great place to start, and then look to sort of, as you build confidence, move into more complicated strategies.
Thank you so much for that. And I think we only have a few more seconds left. So S and Fred, any final words or pearls of wisdom from you guys? If somebody wants to start today and, I guess change the trajectory of their financial health, what should they do?
Just from my side, it's just start. You get to learn as you go. The FinTwit community on Twitter is brilliant. You get to learn so much. The world is more global now. People are willing to share. There's YouTube. There's so many resources out there that you can use to really start formulating your own investment strategy. But don't leave it too late. The earlier you start, the better. Just start.
Cool. So last words from myself is basically same as I said, just start. However, from my own opinion, I think everyone should tackle one thing at a time. And the way I've learned the best way to do it for me is start off with your, if you have any debt, try and clear your debt prior to really getting fully invested. I mean, you can start investing, but try and solve out your debt, try and build up your emergency fund so that should any market condition like last year when COVID came and the markets crashed, you won't need to go and sell your shares at a loss. So first, try and make sure all your needs are taken care of. Secondly, try and make sure that you clear all your debt. Secondly, build a strong enough emergency fund for maybe 1 year worth to 2 years worth of emergency fund so that it's solid should any emergency occur, you are covered. And then you focus on investing as much of your income as you can. Now, ideally, what could also increase or reduce the time to reach your goals investing is if you have one income from your normal job, 9 to 5, try and maybe learn a new skill. Try to learn a new skill. Try to maybe start a side hustle. Because what that does is it gives you more cash flow, right? So, for example, like myself, what really accelerated my investment portfolio was the fact that I had my 9 to 5 job. I also started learning a new skill and had 2 side hustles. And so I was able to take the 2 income from my side hustle and invest all of that because I really didn't need that money, right? My 9 to 5 job was covering my monthly expenses or all expenses that I have. So that's really my last point. Number one, take care of all your debts, take care of all your needs. Secondly, build a strong emergency fund. And then third, focus on investing. And if you want to reach your goals really quickly, try and have multiple income streams because with that money, you'll be able to invest more. Cool. That's all from my side.
Thank you so much, Fred S. and Thomas from the Frank Group. I think this has been quite an eventful night moving from platform to platform. So thank you to everyone as well who has obviously been asking questions and engaging. I think if you have any additional questions that we didn't get time to address, please feel free to tweet these individuals. They are quite responsive in terms of actual tweets and DMs as well. So they'd be more than happy to kind of address anything that wasn't covered in the session. And I think just to summarize, right, the key thing is to just get started. I think at some point, Fred and S hadn't started investing. And I think it was just, in 2017, 2018. So they just started, build your emergency fund, diversify your income if you can, focus on the 300 rule. And I think that's quite a practical way to set a target from a generational wealth number. And remember, the earlier you start, the earlier you can retire with the amount of money that will allow you to live more comfortably and obviously provide for your family. So thank you everyone for the session, and please have a good night. Thank you, Fred, Thomas, and S, and that's a wrap.
Thank you all, guys. It was really a pleasure speaking to you all. Thanks.
Likewise, always here, and both myself and the Frank team are happy to answer any further questions by Twitter or Facebook. Do reach out to us.
Thank you, everyone.